The bankers' acceptance market relies on collaboration among importer, exporter, brokerage firm, and investor to facilitate international trade efficiently. Bankers' acceptance is crucial in providing a practical financial instrument for importer and exporter, ensuring financial security by allowing importing buyers to issue it but with a maturity date after planned shipment delivery. In trade finance, it plays a pivotal role by allowing importers to secure payment before shipping and giving exporters the flexibility to retain or sell it for immediate funds. Brokerage firms use bankers' acceptance to reassure a client of essential funds for investment. Investors strategically leverage this instrument for added security and as short-term liquid investment option in the secondary market, with bank acceptance contributing to risk mitigation.
Next, the reason behind bankers' acceptance issuance. Firstly, to raise short-term funding. It refers to a way to raise short-term funding to meet their liquidity needs or for finance their operation. In addition, bankers' acceptance can offer a quick and simple way for businesses to get the cash that they need to continue functioning. Next, to provision of finance to customer. It refers to a way to provide financing for their customer and operation. For example, banks offer their customer funding in the form of banker acceptance by allowing them to issue bank drafts that are accepted by the bank and act as a guarantee of payment for their client debts. Lastly, to manage their liquidity. It refers to as a way how bankers' acceptance manage their liquidity and reduce their amount of excess funds. In addition, banks can earn a return on excess cash by issuing bankers' acceptance, reducing the requirement for substantial deposit at the central bank.
Bankers' acceptance is a financial instrument that consists of a time drive drawn on and accepted by a bank. It is important in the import-export world. There are few characteristics that we have to know. First, bankers' acceptance is a short-term financial instrument. It represents a bank guarantee to make a future payment having a maturity date within 30 and 180 days. The application procedure for securities is the same as the procedure of short-term loans. Furthermore, the bank will evaluate the borrower's creditworthiness to make sure the borrower has enough money on hand to cover the deposit for the next payment. Second, bankers' acceptance have higher liquidity, and their liquidity with less risk is confirmed. Besides that, they can be discounted or sold on the secondary market before the maturity date. Last but not least, the bankers' acceptance is issued against the party's creditworthiness and offered only for consumers with a strong credit history, such as consumers that have a clean credit records, including the investment in bond.
So, I will be presenting about tenure of bankers' acceptance. Tenure basically means the period between the date of disbursement of the loan and the maturity date of the loan. Bankers' acceptance is generally a short-term loan instrument. So, bankers' acceptance tenure is usually short compared to other instruments. However, it varies depending on many aspects such as terms and conditions and the bank itself. The tenure of bankers' acceptance is usually takes between a few days to a few months. To be precise, it is between 21 days to 200 days. Bankers' acceptance is usually issued to fund short-term financial needs, which cause it to have low interest and low yield. So, bankers' acceptance is a financial instrument where it has short period, low interest, and low yield.
Now, let's take a look at benefits of bankers' acceptance. Its concept is to appear to be a blessing for parties that are unable to pay immediately and need good and product from a seller on credit. Firstly, the benefits of bankers' acceptance is more funds can be raised. This is because it helps companies to handle more business, and also secondary market provides liquidity where it can continue utilize its capital to make more loans. Secondly, lower cost of funding. Bankers' acceptance is the lower fund as compared to other options. At the end, the overall cost of funding is low, made is low, make this instrument more desirable. Thirdly, secure factor. The exporter is comfortable to provide their good because they already have a large financial institution. The entire transaction assumed to be secure because it's being monitored and executed by a financial behemoth.
In conclusion, while the bank is acceptable makes it an effective instrument in trade finance, its future importance depends heavily on how well it can adjust to change in the market, while maintaining up with the technological advancement. There is no debating that using bankers has included benefit for funding and risk reduction, but stakeholders also have to deal with issues that restricted usability and the requirement to adopt with technologies. Trade finance stakeholders have to deal with regulatory complexity and innovation as the global financial landscape change in order to maintain banker acceptance efficiency to facilitate international trade transactions.